Good afternoon, everybody. Uneducated Economist here. So, last Friday we did a conversation talking about how Hong Kong needed to spend $192 million in order to stabilize its currency from weakening against the US dollar. Check it out. Hong Kong does spend $700 million to boost its currency. So that $192 million wasn't enough, and it wasn't enough to stem the tide, and they had to dump another $500 million into the markets today in order to help stabilize their currency from the rapid depreciation against the US dollar. So pretty much, if you don't quite understand what's happening there, is that they have big holdings of US dollars, right? And they're taking those US dollars and they're buying back their currency because they have way too much of their money is now in the system. It goes on to explain it a little bit here. It says, a gulf in interest rates has fueled the recent decline. An abundance of liquidity in Hong Kong has pushed the interbank rates down since December. Meanwhile, U.S. funding cost has been higher and more stable, boosting the allure of parking cash in U.S. dollars. Similar pressure forced the Monetary Authority to defend the peg several times last year. So, yeah, the dollar is growing so much stronger to the Hong Kong dollar that they've been doing this for like the last year. They've been trying to continue to stabilize their currencies, and it just keeps getting stronger and stronger. Weak loan demand and lack of large companies going public have contributed to the cash sloshing around Hong Kong's financial system, depressing rates. And then it goes on to say one of the other problems that's going on here, coming from this gentleman, Ken Chiang, says this is still quite an attractive carry trade opportunity. And it goes on here to say, in a carry trade, investors borrow in currency with low interest rates and use it to buy higher yielding assets elsewhere. So if you can imagine, people are borrowing a lot of Hong Kong dollars and then going off and buying a higher paying asset somewhere else, like maybe, I don't know, maybe the US Treasuries or something like that. And if you're still not quite familiar with how that carry trade works, is basically you're borrowing from one person and you're giving it to another guy who's going to pay back the original person and you some money too. Okay, so basically you just have to borrow money and then find the right person to give it to who's going to pay you back more than what this guy is asking for in return for borrowing the money. That's essentially the simplest way I can explain a carry trade. It gets pretty complicated, especially if you start adding, leverage and stuff like that into it. But yeah, Hong Kong playing right into this milkshake theory, guys. They said that if all the milkshake theory idea is that all these countries around the world, all the central banks, added a bunch of liquidity to their markets, right? And then when the interest rates started to rise, this was like America sticking a big straw in, right? Because as these rest of these countries start to lower their interest rates, America's interest rates are staying higher, right? They didn't drop theirs and they're sucking their liquidity out. All of a sudden, America is looking strong. The dollar is looking strong, right? People want to be in the dollar. And if you compare it to pretty much any currency out there, I haven't found one yet that it didn't gain value against. Like, nobody said it, but cash was the place to be last year, right? I mean, especially when it comes to other currencies, right? Now, there might have been assets that you could have bought that did much better, but when it comes to currencies itself, the dollar is the king, man. Dollar was king. All right, Uneducated Economist, we'll talk to you later.